Are you ready to learn about the property market? Then you're in the right place. This is Everything Property by Pivotal Homes, where we connect Australia's best developers, agents, home buyer specialists, wealth creation experts, and property advisors to the people of Australia. Broadcasted from Whitehorse Studios on the Gold Coast. And now, here are your hosts, Hayden Ashton and Tom Egan.
G'day listeners and viewers right across the country. Welcome to Everything Property by Pivotal Homes, where we connect Australia's best developers, agents, home buyer specialists, wealth creation experts and property advisors to the people of Australia. Now, today's guest has 20 plus years in the property and finance industries. Along with being a qualified real estate agent, he's also a qualified mortgage broker and financial strategist. He has helped countless Aussie families achieve financial freedom using a good financial plan and property as the vehicle. When he is not helping his clients, he's developing property himself for his own portfolio. I am pleased to welcome director and founder of Property Investment Advisory, Darren Fisher. Welcome to the show, mate.
Welcome, mate.
Thanks, guys. That was one heck of an introduction.
It's funny, everyone says that, but mate, thanks so much for joining us. I touched on a few things there. 20 years of experience in the property finance industry, and you've helped hundreds and hundreds, countless of Australian families achieve financial freedom. And we want to go into that and all sorts of intricate details of what you do and how you help people. But what I normally like to do first is just provide the people at home, because I feel like it gives a good foundation to understand you as a person, how you came into the industry, what you're doing now, Property Investment Advisory as an organisation and its ethos.
Sure. I guess paying homage to that introduction, it was a really innocuous start into the industry where I guess the first 10 years of my life was really just dealing with people one-on-one in the hospitality industry. Okay. And then I realised that, I'm never going to find any financial freedom if I stick into that game, that's for sure. And then I had a few friends that were in the finance industry, and they introduced the idea of coming in to start, I guess, making inroads into that industry, linked in with property, which was 20 years ago. It was quite a novice idea, buying property via a financial structure as the main implementation plan. And it so it went from there, and I guess more and more people became aware of the idea that, look, when you're investing into property, as much as it's a property asset purchase, the idea behind property, and respectfully, is to, as an investment tool anyway, is to increase the financial benefits to you and your family. So really, when you look at that side of it, the real primary driver for buying investment properties, well, it's finance. So I guess the key, and what has always remained the key from there on in, is, well, let's look at, sure, buying a property, but let's work out why we're buying it, whether or not as an asset it's the true and correct asset class suitable for what your priorities and requirements are, and certainly your financial circumstances allow, and really define what budgets, timelines, exit strategies you want to achieve out of it before we actually implement that physical and tangible asset. So it's very, I guess, finance driven in that we don't like to guess with how much or little or how much it will owe a person to buy a property. And then further to that, you hear countless horror stories where people have bought property and realised that, well, hang on, I bought the wrong thing here. I can't afford my own lifestyle because now I'm hemorrhaging because of this property, whether it's, it's not renting, it's not rentable. Sure, I've got a big block of dirt, but, I'm buying something that is costing me $300, $500, $400 every week and not getting any better. We don't want to have that scenario for our clients, and certainly when you understand that financially we can, I guess, design the property accordingly with, the block size. We go from the ground up from there. What sort of tax benefits will suit the taxable incomes, the household taxable incomes, and what sort of rental yield we need to achieve relative to that total purchase price that will allow a cash flow positive scenario for the client.
So you got in the industry, I suppose, more so wanting to better your own personal situation out of the hospo industry, and you're like, I'm not going to be able to get ahead by doing this, and got in there sort of as a way by that. Is that right?
Yeah, well, like anything, we don't work because we love to work, essentially. And again, that's a generalisation. Some people are a little bit the other way, but for me, it was more so, well, how do I ensure my career is going to be, go successful? And look, I come from a construction family. My stepfather was in formwork. He had a formwork construction business. My brother, he's a builder. I started on site, and I started as a building cadet, and it was always an interest. However, I just wasn't ready for it at that younger age. So I'm very familiar with it, and obviously leading into now developing and the usual things that come about having a holistic knowledge of that landscape.
And so you mentioned there briefly, you're designing the property, not literally, you're not designing the floor plan, although some cases you probably are.
Yeah.
And we've had discussions around that on particular blocks, but you're designing, I suppose, the property option to suit that individual. So it's not a sausage factory or a churn and burn type. We've got 100 of the same thing. Here it is. This is the one, regardless of your situation. You're really identifying that person, the individual circumstance, their goals and what they want to achieve, and then finding a suitable property to match that.
You're spot on. One size doesn't fit all. I'm certainly a big believer in that, and everyone has their own, not only financial circumstances, but also their own timeframes. Their own risk tolerances, their own budgets, and even comfort zones. Some people, their only experience in buying property has been their own home. So taking that mind shift to an investment property is sometimes challenging for people, because they're too busy thinking, well, hang on, I need to live in this property, and if I'm not going to live in this property, well, it can't be a good investment. I take that out of the equation as much as I can by really disassociating the colour of the carpets and the curtains relative to, well, let's work out financially what it is we're even doing this for in the first place. And if we can stick to the financial plan, well, certainly I can find a property scenario that will allow a perfect marrying up of the strategy to the asset. And then from there, we take away a lot of the exposure, the financial exposure, because that's what stops a lot of people. People are held back because of that fear of loss, more so than the greater desire for asset wealth.
Well, last week we had a guest on, Michael Pell, and he said it best: more people lose money from indecision than wrong decision. They sit around and wait based on, is the carpet colour the same? Is the carpet colour going to be right? Or I don't like that tile or whatever. Meanwhile, it's not even relevant to how that property performs on an investment basis.
Well, again, and everyone's waiting for that, either that white unicorn dancing over a rainbow in the perfect time to actually find it and ride it. It just doesn't happen. There's not going to be a better day than today when you've got all of the information in front of you. Because again, what's going to get better? Well, the only thing that'll change is you'll have less time, and the greater the amount of time you have, the greater the appreciation of the asset. And if you're looking at a mortgage reduction program, which is what we also do with generating a financial structure that will allow the income and the tax benefits from the property to feed into your own personal residence mortgage, you're paying more bank interest the longer you leave it. So it's costing you more not to go ahead than it is to wait for someone who's either uninformed about the price and the value of their property, or the land, or waiting for a builder to just go out and say, hey, I'm going to give you a free property. Who wants one?
Yeah, that's right.
It doesn't happen.
Yeah, exactly right. And I think that's people have to take some advice and trust the people around them, much like our partners do with us, whereby we've done the hard work in configuring the floor plan so that they're ergonomic, they're cost effective, they're livable and practical. We've developed our specifications so that it works for the majority of the masses. Much like you and the plans that you create, people have to trust in your ability and the fact that it's worked for countless other people or countless families around Australia. That the same is just it's just about taking your situation, filling the boxes, and replicating.
Yeah, yes, and taking that a little bit further, it's understanding what type of property will suit the demographics of the area as well. You've got some great 4-bedroom, 3-bedroom, and even with what we're finding with COVID now, what's come to light is people don't have to work in a city. It's decentralising now a lot of the demand for property. And what we're also seeing is what would normally be adequate as a 3-bedroom, now people are looking for 4-bedroom because that extra room becomes the office. Because now people feel, that's going to be the way of the future, and I don't see it changing anyway, because obviously it's more cost effective for businesses now that they've been forced, their hands been forced to allow people to decentralise from the office. So, the design also needs to match the demographic audience, and that by that is if we're looking at a specific area or a specific budget, we want to ensure that, okay, well, if we can afford, this type of property or to this value property, well, we've got to find the right value land, first of all. And then from that, well, what type of property will suit the people relative to that location for the land estate? If I'm, for example, and this is just a very simple example, if I'm in the CBD, chances are I'm going to rent out a 1-bedroom more effectively than if I'm out in the boondocks trying to find a tenant for a 1-bedroom, because that's what the audience wants.
Correct.
Professionals that would like a 1-bedroom studio, great location next to South Bank or whatever it may well be. So, understanding the design elements relative to the audience, and obviously the budget of the audience for that rent that comes through long term, is a big part of what we do, and obviously why we talk to find that perfect fit relative to the audience in that area.
And I think, sorry.
I was just going to mention that shift has definitely happened with people working from home. Like, I just put my property up for lease last week, and out of 7 applications, 4 were running everything from home. Yeah. And they're working for companies. None of them even work for themselves. It's like, okay, we're now just been based at home. So it's just small things like having an extra aircon in the other bedroom or the study was a big point to them. Okay, cool, I'll bring it up, I'll just install it. That was all, or go ducted, or just pay for a split system, be in that room because we already have splits in the other rooms. It was just amazing, the feedback on how many people are working from home. Like, some of them were in government jobs. I was looking at their applications and they're only at their office once a week. I was like, it's so strange how quick it shifts.
That's right.
I think having someone on the forefront and being, I suppose, not properties consistently evolving and changing, like we live. We used to go out and eat pizza at the restaurant, although you can eat pizza. Now we get on our phones and it comes to our door in 20 minutes. Like, the way that the world works is completely different. Yeah,
Hader, and the same thing, even with first home buyers. You heard of the shared rent scenario. Yeah. Well, I'm looking at looking after a number of first home buyers right now, and they're looking at even the 4 bedrooms, because they think, well, okay, well, if I've got a 500 borrowing capacity, 500,000, and I can find a package for that, well, great. Let's make the bedrooms a little bit bigger. Let's put air conditioning and USB ports and television ports in each bedroom, because what I'll do is I'll rent out each bedroom. So instead of a 3-bedroom, they'll go 4-bedroom and put two friends or colleagues in for for paying down their first home. So there's that trend that I'm noticing as well, because a lot of younger people are certainly, they're astute. They're astute enough to know that, okay, well, hang on, it's going to be, instead of me paying $500 a week for the mortgage, why don't I bring in $400 of rent from my friends, give them a great place to live in a share house with me, and it costs me next to pay it out, and then I can pay the thing out sooner.
Yep.
So that extra bedroom, as again, it's finding that 4-bedroom scenario now is really becoming a big thing, and it doesn't need to be a big 4-bedroom. Where traditionally it was, you need a 600 square metre block of dirt with a big 4-bedroom house on it. Well, sure, they're going to be those, but now we're seeing smaller and smaller blocks of dirt that are coming to market. Sub 300, you can still get a 4-bedroom on there with a 60% side coverage. That's going to allow a younger person to get in probably, $150,000 cheaper than someone who's bought a 600 square metre block and wants to put a 300 square metre house on it. But
the average is about $375 now, and you can get a nice 210 square metre home, 4-bedder with a media room. And we don't really, me and Hayden don't really sell homes without the media room as well. The 4-bedroom plus a media room, we've sold the ones with 4-bedroom only, and they don't rent as good. And you only have to add an extra 10 square metres to be able to achieve the media room and the designs, and it works. It makes a big difference.
Yeah, absolutely. The second living area. Especially in a shared renting scenario, it's amazingly popular. And I get that, more often than not nowadays.
Yep. And I think what this whole COVID thing's done as well is it's brought the areas that were probably considered a little bit further away closer in, because the people don't have to travel to the CBD as often. People aren't as reluctant to live 35 minutes away because they're only going there twice a week and they've got the train line there. Because we know in these greenfield areas, they're quite, the infrastructure projects in the pipeline are quite, extensive. So being in those areas, you look at Springfield as a prime example. There's no reason why you wouldn't want to live in Springfield. There's everything you possibly need there, or anywhere like that. North Lakes, Mango Hill,
yep.
all those areas have those amenities at their doorstep. But you're getting in the market for 500,000 or under, opposed to being somewhere where 12 months ago you would have only settled for Tingalpa or Indooroopilly or Paddington or something like that.
Yeah, absolutely.
But it's out of your reach.
Yeah, and that's it. It's also benefit commercial in those outer areas, because now I guess people have decentralised from those CBDs and whether or not they want to stay in the high rises where they can't use an elevator.
Yeah.
Well, now they're looking at smaller shop fronts, where it's closer to their own residents or certainly not a requirement to be centralised in the city itself.
Yeah, it'll be interesting to see how the commercial space, the commercial property market, works out. Look, we have no idea what's going on in that market because we're not involved in it. Maybe you do. I'm not too sure, but it'd be interesting to see how, with a push to online and the fact that people aren't consuming the way they used to, you don't have to go to Louis Vuitton and walk in the door and buy a handbag. You can do it online within 5 minutes. It'll be interesting to see what those shopping centres do.
Quick update. What's happening is we're finding a lot of online businesses now are really finding their strengths. Certainly if you had Afterpay shares, 6 to 12 months ago, you'd be a very happy person right now. But the man sheds, the smaller, sheds, 150 square metre sheds as a commercial thing, they're flying out the door.
Right.
Yeah,
it's just a larger premise where you need to hold stock there. You don't need to.
Bingo. That's all it is. So there's a lot of those in there where, on that space, I'm seeing a lot of interest starting to jack up.
Yeah, right. So you do a bit of stuff in the commercial sector as well?
Well, absolutely. Not a lot, just a bit.
Yep.
I think understanding where the trends are is a big part of what I try to do. I mean, even when we look at, putting a property market together, there's a lot of research that goes into demographic trends, migration trends, that we want to keep ourselves, abreast of. With those sheds, I've got a builder there that, for example, who just does those.
Yeah, right.
And 6-pack at a time, and again, because online businesses are flying.
Yeah,
right.
They need somewhere to have the small team, to hold a couple of desks, hold a bit of stock, but you actually don't need the big showroom floor that costs you the extra $4,000 a month.
Bingo, you don't need a shop front. All you need is 150 square metres, a mez deck with a toilet.
And you have your address, and clients are happy to go there if they need to see something.
100%.
I'll go to Mo if I actually want to try something on, but I don't need to pay in the shopping centre where it's an extra couple of grand a square metre.
Well, that's right. And you look around Brisbane as well, like the big thing is the airport that opened this year. Obviously, it was a big, underwhelming because of the COVID scenario compared to what they were expecting.
That's right.
As a fanfare.
Poor buggers. There was so much build up to it. Now it hasn't been used yet.
It's obviously disappointing for the airport commission, but in and around those areas where there's infrastructure and you look around just off that Gateway Arterial Road. There's some great prime flat land there that's cheaper than anywhere else in any other capital cities with next to a port.
Bar and all that sort of stuff. They give it away there. They literally give land away.
Wow, just a thought. Anyway.
Yeah. Hey, mate. That you touched on it there, but I suppose rarely do you find someone who has knowledge, or I think best described on your own website as market intelligence, as yourself. I mean, a lot of people either specialise in residential, commercial, duplexes, whatever it may be. But it sounds like you've got quite a large exposure to all sort of sectors, and also nationally. Do you also do properties interstate as well, not just Queensland?
Yeah, absolutely.
Yeah.
And I guess the reason being is more so that Australia runs in property cycles, and that's extremely important to understand what your timeframes are. A lot of people will just say, "Oh, well, I'll just buy this property." Traditionally, it would be, "I'll buy a property here and I'll set it and forget it, and hope that it goes up, in line with the time frame that I want to have for my exit strategy to cash out, or whatever it may well be." Understanding the dynamics that will create increased demand in any particular type of area allows us to work out, well, based on those fundamentals, factors, we know that an increase in demand will lead to an increase in market value. And it's always that supply and demand ratio that comes into effect there. So understanding where those trends of people movements are and what the triggers are will allow us to work out, realistically, if you've got, you want to build a portfolio in 20 years of 5 properties, well, we know that we're going to have to create enough equity within a short period of time on each of those properties to leverage into the next one, so that we're not taking security out of your own principal residence. So understanding and utilising that knowledge on what areas, what type of properties within those areas will be of the greatest demand relative to the amount of supply will determine the increase and the speed of that increase in market value based on that demand.
Because not all properties grow together, do they? Like a lot of people think, no matter what property I buy, 7 to 10 years, it's going to be doubled. That's what they say. Or that's what people have in their mind, because that's what's happened, right?
It's been bandied around for years.
Yeah.
They've heard that. That's right.
But as we know, the market conditions for each individual location are unique, and they're influenced by a myriad of different things, like infrastructure projects, new schools, or like the runway. You look at Sydney in the west, the new airport, places like Oran Park and all that sort of stuff, which are considered donkey's years away from Sydney CBD, and now 800,000 because of the fact that that airport's going in. With the airport comes a heap of other infrastructure. It's really important to understand that, isn't it?
It is, and if you break that down to the primary, I guess the primary benefit, it's employment and long-term employment. And if I'm putting together an investment property, well, I want to ensure the property is going to be affordable for what that new employment income bracket is.
Yeah.
So if we've got, an airport, let's say the average income for the airport's going to be 80,000 per annum. Well, we know that we don't want to go above 40% of that, of what the net income would be for rent, because generally people seem to peak out at around that 40% of the net income for rent. So those dynamics will certainly help when we're designing properties, and that's that difference between choosing a bigger block over a smaller block. A 300 square metre or a 200 square metre property. So, the primary driver is the employment, for that migration, and with the airport will come thousands of jobs, and then that's direct jobs, and then there's the indirect jobs. That's right, and even the university out at near where Oran Park is.
Yeah.
I can't remember the name of the place out there, but 75 k's out of the CBD of Sydney. 75 k's.
Yeah.
Paying 800,000.
Like we're in Toowoomba. That's
Campbelltown.
Yeah,
that's where it is.
Yeah,
it's
okay.
Campbelltown.
All right, and I think particularly in the Queensland market, obviously that's where we're focused purely, just in southeast Queensland. But what we find is that people understand it, specifically people from interstate, because we say somewhere, like, sorry to use the example Springfield again, but if we look at Springfield and we compare that to Parramatta in Sydney, people are like, well, it just makes sense. Whereas if you said that to, Georgia here and said, hey, do you want to live at Springfield? She'd be like, I'm assuming. Anyway, I don't want to live there because it's too far away from where I work and play or where my friends live, So that's why the investors have, I think, soaked up have been so attracted to those sort of areas because they've seen it happen. If you look in Sydney, the greatest compliment is plagiarism or whatever it is, and the Queensland government's done quite a good job in doing that and taking the pressure off the metropolitan of Brisbane CBD and engaging or starting to create these almost, I think they'd call them satellite cities, like your North Lakes and your Springfields and the redevelopments of Logan, Coomera, Flagstone, all those sort of areas, and it's taken the pressure off CBD, and that's why you can drive through a tunnel at 8:30 in the morning and still not be backed up in traffic.
Well, again, remember, one thing that Queensland's enjoying right now, in southeast Queensland, not saying all of Queensland, because, Wide Bay up, it's a different planet to southeast Queensland. We're often compared, with our...
Oh, look here, Siri's got the whole conversation.
Okay.
Anyway, I don't want to live there because it's
Don't
too far
listen,
away.
But remember, what we're seeing right now more so than ever before is our interstate migration has topped the nation again. So it's not people that are moving from, for example, the Gold Coast to Springfield Lakes.
Yeah.
It's people that are moving from Victoria and greater Sydney region and Perth or Adelaide or wherever it may well be, it's new people going to those areas. And the reason the government have done their macro plan, I still remember when it came out with under Petey Beattie.
2006, wasn't it? 2006 South East Queensland.
Oh, yeah, about that, yeah. I mean, it was a $55 billion plan back then, which was the largest ever undertaken in the nation. And it was all about creating the infrastructure to decentralise so we didn't have the same problems of Melbourne and Sydney, you know, with the chaos of traffic and so on. So by doing that, it's allowed all new migration to the area because people have realised, well, I can go in here, I can sell out at Sydney for $1 million and I can get into a mansion there for $500,000.
Yeah, exactly.
And I can still work at the Mater Hospital, I can still work at the university, I can still work in my same career because all of those new jobs have been created within that satellite city region. So, and relative to new rail, new major arterial roads,
education,
public
retail.
You've got good private schools at most of these areas too. They've all they've conditioned around the families to actually live out
and
there.
golf courses.
And golf courses, that's
You
right.
got your Brookwater, you got your one over North Lakes.
The resort. I was hoping Dazatani was going in.
Yeah, it's crazy how they just kind of faded away, didn't it?
We'll sell that for a while.
But it'll be interesting to see what happens, especially, I mean, Queensland's had the highest net migration for quite a while, but Melbourne's had the highest international, hasn't it?
It has, yeah. Well, Queensland's only just topped, it's now in the last 2 years.
Right.
And we had Sydney and Melbourne were the key players in interstate migration because of the employment. But the conditions we're seeing now, the same ones I saw back in 2005, where we've got the relative disparity in prices. We're literally half Sydney and Melbourne for the same type of property in the same relative location, if not lower than half, if you're looking Bayside, for example. And we've got rapid employment growth plus the digital era on top of that. So, we're seeing it right now thanks to COVID. There's tens of thousands of people every month coming out of Victoria to here, and they're buying property sight unseen off the internet simply because they've got a residence up here, they're happy with it, they're happy with the price, and I can get out of Victoria legally and into here because I've got a registered address now for a property. And again, it's the same conditions. And South East Queensland's been spinning its wheels for the last probably 4 or 5 years where, forecasts have been saying, look, it's going to happen. And this year is really when it is happening, when it's probably forced its hand because of what's happened down south.
And I feel like we've almost been unlucky in terms of, you mentioned it, property cycles. But if you look at, as you would know, Brisbane generally follows Sydney and Melbourne in terms of their booms. Would you agree?
Always.
Yeah. And so when we look at when Sydney and Melbourne have had their runs, there's been some sort of event, whether it be the GFC or in 2007 and 8, or you look at the the floods in 2011, that have, I suppose, hindered or stunted the growth of Queensland property prices. But we've continued to just tick along at 5 or 6% without having that boom that Sydney and Melbourne had.
And look, taking it to the next level, the research I've taken on lately has been, well, what's always happened after a GFC or a pandemic? In this state's all the way back to the Spanish flu in 1918. Everyone goes to bricks and mortar. That's it. They want a surety. They want the confidence to know that as an investment now I can go into this. It's tangible. It's not speculative. I'm going to go into that. And we're seeing it now. If you look at, you talk to any land guys, which you do every single day, all day, they were seeing 20 to 30 people a day on the weekends. Now they're seeing 200 to 300 a day.
Yeah, that's right.
For dirt. So we're right in the middle of it. And it's just, as I said, the psychology's been replicated. And post-GFC, 2008, 9, 10, guess what happened to the property market? 11, 12, 13, 14. It went ballistic. Gangbusters. And we're going to see the same thing now. For anyone who's astute and not affected by COVID, well,
now's
money's
the time to buy.
Well, that's what they're doing.
I think there's those lessons too where when these things happen and they realise, their job's on the line and they've not paid attention to their future at all or investing, I actually don't have anything if something goes wrong. They speak to their partner, what have we actually got? We've got some really nice holidays we can remember. We've got 2 leased cars in the driveway and we've just got expensive things around the house, but it's like, what do we actually have? When's the wake-up call to go, I need to start investing in my future? And I think that's, where these young first home buyers have an opportunity, but just people in general to invest in something. Okay, I just find that it also gives them a kick as well. Because now COVID's hit, what money do I have? What income do I have if I do lose my job? I haven't built any equity. I haven't got rental income coming in. I think there's a big wake-up call for them.
You know what? One of the big keys for that wake-up was, what happened to superannuation funds when this happened?
That's right, they dropped 30%.
Guess what people realised? You know what? Well, hang on. If it's that volatile, how the hell am I going to afford 30 years in retirement when it can go 20% overnight to a drop?
If we have a bad market when I'm 60, what do I do?
Yeah, that's right. Dividends on their shares.
Yeah.
And that's where the realisation came. So you're seeing more people than ever before taking the 10 grand out of their super and going, bang, give me some dirt.
Yeah, that's right.
And because, again, people realise that, like you said, I've got such a volatility in my retirement right now. How am I going to afford, or how am I going to get or have confidence in my passive income through retirement for 30 odd years when my superannuation can drop 20% in a week?
Yeah.
So,
and especially a husband and wife with, you've got a family of 2 or 3 kids. One of the, you've got 2 incomes coming in and one drops down because of COVID and you're relying on one income. You realise we're actually not in a good financial position here. We've just been earning high income and done nothing with it. That's where I think reality hits for a lot of people, and then they want to see professionals. How can we be in a position where if COVID hits, it's not going to affect us dramatically if one of our jobs are lost, or we got to take a cut by, overtime's cut off on both of their jobs, so they lose an extra 25% each of their income. So I think it's having that, and that's where seeing a professional comes in. But that's where I just think there's, heaps of times like this is where a lot of people do come out and realise I've got to do something. Yeah,
absolutely. And again, it comes to that point where people have been waiting for the perfect time.
Yeah. Well, I mean, you rewind to March and the arse was going to fall out of the property market. We were meant to be in,
30% down.
Yeah, 30% down. And then you have Westpac, Australia's biggest bank, coming out 2 days ago saying that they're forecasting a 20% increase next year.
Yeah, that's right. I mean, again, it's... And I won't get into the argument about the mainstream media and what their agenda is, but... the Real Estate Institute of Australia just burred straight up and said, if you probably would have seen the article that they said straight back, well, look, here's the truth. Right now is you've got the building supply has been restricted massively. You've got still the same demand for people, whether it be as soon as the COVID finishes and people are back to work, which will be any time soon, you're going to have that same rental demand, that same continually growing rental demand, but you've had a complete bottleneck of construction. So
where are these people going to live?
Bingo. And that's the smart move. I've been putting my people into property more so than ever before the last 6 months. All of my smartest guys have been all over me like white on rice because they know that when you stop the funnel of construction and you've got a massive demand build-up, there's not going to be, 3 to 4 people looking, putting an application in for the rental property. It'd be like post-GFC. There'll be 30 to 40 people putting an application in for that rental property.
Well you're dead right. I put my property up for lease in Springfield. We settled in January, me and my brother, and my brother's like, I've just settled, and then COVID's happened in March. Property prices are going to fall. He's like, he just bought his first house next door to me. It's like, this is the worst thing I've ever done. I'm like, just relax. It's going to be all right. Trust me. And then his is a month away from completion, but he's obviously gone in the back of mine. We built the exact same thing. So I said, I'll believe in it, just back me, like do the exact same thing as me. The rental appraisal was $460 originally, and that's what they said maximum you'll get. We did the inspection last week at PC, and they go, we'll run it at $480. I said, make it $500. They said, we'll see what bites we get. We'll probably get $490 maybe. We've never gotten over $490. I'm like, let's put it $500. We'll see how we go. I'm quickly checking on the house for defects. I didn't realise that it was at 10 o'clock instead of 11. I rock up, someone was 20 minutes early because I'm just about to leave. So I thought it was someone doing defects, like a painting, someone in like a paint outfits, just like got paint all over them. Like, it's just a trade, come in, like, can I look at the house? I'm like, yeah, go find wherever the defects. The supervisor, like, no,
Right.
I'm actually coming to inspect the property. I'm like, oh, okay. who are you? I'm like, oh, I'm the owner, but I'm not meant to be here. So I show her through the house. She takes 20 minutes. I go out the front. There's 16 couples out there.
You go.
And this is and I've put the property up, expensive at 500, and I've got 16. I'm like, I didn't do it enough. But anyway, we committed at that. But that was, or I got the price right, but 16 couples turned up, and then we got all these applications following that. So, and that was we did it on a Friday morning before the weekend, and that's how much we got. So going from being scared, and then I told my brother, I'm like, rented before I got the keys. So before getting the keys, I only got the keys yesterday. I've got a lease signed, bond paid, everything done, and I got the higher amount that we ever predicted back in January at 460. You got nothing to worry about. So,
and you just have to look at the vacancy rates to see that vacancy rates have fallen. They're well and truly under 3%, which is what you'd be considered a balanced market.
Unless you've got a one-bedroom apartment in the city.
Correct, yeah. I'll put a little asterisk there on that.
And again, it's understanding those trends and what drives certain trends that will allow us to ensure we minimise exposure for clients. And it's just taking a step back and thinking, okay, well, let's think logically here instead of reading all the garbage that's on the news, the mainstream news, and following the sheep. And that's, you look at the numbers are really, really coincidental or not. 95% of people retire broke or near broke. 5% people retire self-funded. Most people, 5% of people will buy when there's a pandemic or an issue like this. You look at your Warren Buffetts. They'll advise people to go out and do it now. So, the numbers are about the same. About 5% of people will buck the trend and go and do this. 95% of people will run for the hills. Like with COVID. Oh, it's too hard now. It's definitely, I'm not going to do this. That's what we noticed. We noticed a real drop-off of new customer inquiry. Not from my existing database of buyers with portfolios. They were all over us, but the new customer inquiry dropped off dramatically, and it's the same trend. Majority of people get scared, don't do it when they should be. Majority of people retire broke. It's a strange coincidence that only a small percentage of people will go ahead when it's, mainstream media painted out to be the wrong time.
Yeah. It's funny that it's almost like, it's funny because Australians, as we know, have a love affair with property. Like, we just love it. It's almost part of our fabric. Yet when you hear a statistic like that, you wonder, how do we love it yet we don't take action?
And so it's simple, the lack of knowledge. I want every one of my clients to know what I know. When they know what I know, they'll understand exactly why we're doing what we're doing. And how they can take it to the next level. That's what I want to know. But most people are uninformed because to go to your local real estate agent and respectfully, all they're going to show them is, well, here's my 5 listings. They're the best 5 listings on the planet right now at the best price, and they're going to be perfect for you. It's got nothing to do with financially what's going to suit them or anything like that. And as I said, respectfully, that's not their role.
It's two different things, isn't it? We were chatting earlier on in the series to buyers agents, whereby you have Australians go to the person selling the property for the buying advice in terms of real estate agents. So of course that advice that old mate Ray White, nothing against them, that's what their job is to do, but
no names.
But that's essentially what they're going to recommend the 5 properties that they have currently up.
Of course,
on listing.
Yeah. And that's why, as I said, with us, I don't want my clients, they don't need to get to property before we understand financially what's going to be ideal for their circumstances and budgets and risk tolerances and so on, because it's not so much a price point as it is the rental income, the tax benefits that will make the real, details or the benefit make it to match their budget. Because price point's one thing, but if it's an $800,000 purchase and it's only going to rent for $550 a week, they're going to be negatively geared. And it's going to take away from existing cash flow.
And impact the lifestyle. It's like, what do you, like you said, what are you actually doing this for? How are you doing it? Because depending on this product or financials that we actually choose to go down, this can have a great effect on your lifestyle. Are you willing to live more lean and miss out on certain things right now to be more aggressive, or do you want to take a slow approach? Or there's multiple ways of looking at it, but I think a lot of people always forget what, they get a borrowing capacity of 550, let's borrow 550. It's like, but how do you live right now? Do you want that to change?
Yeah,
Spend
that's right.
450, what's the weekly budget that you can allow for? And if interest rates go up, do you have that buffer to maintain that lifestyle? Because it's always been going down for a while now.
I had that same conversation with a first home buyer, and it's a couple moving up from Victoria. One's a Queenslander, one's a Victorian. They're moving back, and they would have been up here already. One's a Virgin employee.
I'm glad you finished that sentence.
Yeah. Didn't even figure it out. Sorry. And look, they had a borrowing cap of 600,000. I'm looking at properties for them at mid fives, low fives, simply because there's always going to be something that comes up at some point, and primarily interest rates. Because in 10 years' time, they, instead of being maxed on their borrowing capacity and their serviceability, will get them much lower. And again, that's just understanding that they don't need to go all the way to the top of it. And unfortunately, most real estate agents, because their commissions are percentage driven, will go, well, hey, let's get you the most expensive property because I'm going to make the most money out of you. And again, respectfully, I say that. But when it comes down to building portfolios as well, it's crucially important to understand the cash flow scenarios of your purchases, because generally, I like to start someone with a high ROI on their property. So instead of, I generally go something that's going to give them minimum 5% rental yield and high tax benefits, because we can shuffle all of those things and the income back into their own mortgage.
So about $1 per thousand. So if you're at a 500,000 purchase, you want to be getting 500 away.
Correct. Yep. Yeah, but then you add in your tax breaks on top of that. You should, on 100,000 household income, you should be able to, on a new property, you should be able to get another $5,000-$6,000 net out of your income tax on top of that. So when you add in all of those monies, and then you have, with a clever structure, we redirect into your mortgage, we can start that opportunity, or that strategy first up. But when we go into our next property, maybe we'll look at something that's a higher land value, like a $700,000 property that rents for, say, $550,000, $600,000, and it might be on a cash flow neutral or slightly negatively geared scenario. But because we've got such a high cash flow positive property on the first one, they balance out.
And the other one could be more capital growth driven. Or
100%, Tom. Yep. So there's different scenarios, and that's how I'll build portfolios for my buyers to work out, well, how do we structure your portfolio so that one feeds into the next?
And the strategic plan you're touching on, that's not necessarily something we designed today, and that's what we have to stick to, because circumstances, I'd imagine, for the person or the individual will change. Rents go up, rents go down. That negatively geared property that you thought you were buying at the start, the rents have gone up there, and now that's actually quite a positively geared portfolio. So that would then determine or be a very important factor in the next property you buy. So that strategic plan would be constantly evolving, I'd imagine.
Yes, remember, servicing is as important as equity. Because you can have a lot of equity, but if you can't service the debt in the lender's eyes, you're not getting the loan. You're not buying you're not getting the prize. So it's certainly a big factor that I look at when we're justifying, whether we're starting, from the starting blocks, or a lot of people will get stuck on just the one property because they've basically tied themselves in a knot with a negatively geared scenario. And not a lot of equity, not a lot of servicing, so they can't go to the next level. Sometimes we need to go backwards to go forwards faster.
And I think having that team where you've got the broker yourself and you're the property strategist, depending how you're doing it, or you're doing both, where like my property just finished, I did the final payment, the bank calls me and says, look, we can take off, we can go from 3.1% to go to 2.7%, but we want you to put in 50,000 to reduce the LVR on the property, but we're going to give you a better percentage. But it's like they're not looking at the actual structure or how many other properties I've got, or the strategy in place where yourself is like, okay, I could put that 50,000 in, but what is that hindering? What cash flow do I need, or cash do I need offsetting something in the moment, then buying the next purchase, instead of hindering that and sinking too much into one of the investment properties. The bank just looks at it, okay, I've just got this one loan, this is what we can do to reduce the rate.
Yeah.
And it's like some people would just jump on and do that, but it's like, okay, you've just taken that capital. What is that doing for your next strategy? They're not communicating to you. So we're having a broker that's communicating to the banks for you, and you've got a strategist. They're all communicating together for the outcome. That's the huge difference and flaw that I see some people trying to do it by themselves a lot. It's like, but you don't have a full team that's communicating the right step. Okay, I just saved 3%. Yeah, but or 0.3%. What did you lose somewhere? Like, what was the next step that you just hindered? Now you're 2 years from purchasing because you've sunk too much cash flow into this investment property.
Yeah.
And then all of a sudden they're like, oh, I didn't.
It's not just that too.
And that's just one part of that. But it's amazing how big that picture is when you have that team.
100%. Because a lot of people don't take advantage of the tax benefits because whether or not their accountant is ill-informed or not proactive, but most people will write down all of their outgoing expenses for their investment properties and their portfolios, but not a lot of people know that you can get that tax benefit back in real time.
That's right.
Tax variations and etc. So you've got to have the right accountancy team backing you to give you those tax benefits in real time, so that again it helps with your serviceability. And again, when you take those tax benefits on top of the rent and stick them in an offset facility, and you've got a mortgage of say 3%, well, every dollar that you've got in that offset facility, because it's saving you 3% of bank interest, money saved is money earned.
That's right.
It's the best savings account you'll ever get. I mean, you go to a bank and say, give me 3% on my savings. And laugh at you.
Yeah, that's right.
It's like a lot of the wealthy guys you meet, they say it's like you just watch them and see what they do. They actually just, even though they don't earn the highest incomes that you think sometimes, they just use their money very smart. How do they save the most that they earn out of their 100 grand a year, 150? How do they save as much as they can?
Yeah.
Which is then just builds compounding over time. But yeah, it's crazy how it can, just that little tweaks can change the difference. And the proper communication channels. Okay, actually, thanks for giving me a call, the bank. But, now I need to talk to, there's no communication there sometimes where the broker and yourself can actually communicate going, this is the best strategy for how we're going to do it. This is over the next 2 years going to save the client an extra 10 grand in their pocket.
Well, remember as well, banks work for shareholders.
Yeah.
Not the consumer. So
they're
most
in the
of the time,
making money.
bingo. They want to get as much money in now while it's low interest rates as they can. I would anyway. That's what I want to get in as much as I can. But a lot of people will get themselves heavily restricted or their results limited because they'll only look at one lender. Let's say I've used CBA all my life, and I'm only going to stick with CBA. So if I go to the lender at CBA, they're going to show me only the products that they want me to know about. They're not going to give me a full explanation about all the other product saving tools there are to reduce my mortgage faster and save on bank interest. Whereas by utilising a broker network and not a broker who's already owned by the bank, you look at some of the broker groups that are actually owned by the major banks. The brokers will give you what I used to enjoy doing was allowing people to say, well, here's your bank, but how about these other three? Guess what? So it's, instead of what you thought was amazing, we've just smashed that to pieces with these other three lenders right here that you were never going to consider otherwise. And their products and their fees and the like. So it's certainly, the more information is the key. Knowledge is not only power, it's profitable. But even on the ownership, taking it to that next level, your solicitor. A lot of solicitors will just go, here's the contract or a conveyancer, and they won't even ask, well, is it investment, and have you considered tenants in common, where we can structure the ownership of the property relative to the taxable income of the two owners. So the highest taxable income earner, well, why don't we put it 90% in favour of that particular person on the contract, on the title, so that 90% of the tax benefits will come off or be deducted against their taxable income. So a lot of solicitors don't know or don't care. So
too hard basket. I'm only getting paid $1,000 for this.
Well, they don't know, and what puts knots in my stomach is when I go to I have buyers and they buy something off the plan. We've got a really great financial strategy. And I go, I'm just going to go to the cheapest conveyancer I can to get this thing signed up, and all of a sudden I just think, well, hang on, it's an off the plan contract. They're never going to mention tenants in common. They're not going to help you. They're going to absolutely botch it up because they just don't know any better.
Yeah.
Yeah.
And for
Or
the
never
sake-
even done off the plan sometimes.
That's the other point.
Yeah.
They will completely botch the whole thing, you know. And what we try to do is inform our clients as much as possible on the holistic nature of the transaction, because it's not just the property,
Yeah.
it's the finance. It's not just the finance, it's the tax benefits, how to maximise those, and it's not just the buying it on. It's how to structure the ownership, and when you put all of those components together, and all of those participants are working cohesively, that's when you'll have unlimited success.
And you
Yeah.
might try and save that $500 on that conveyancing fee, but the ramifications that can have on you is phenomenal. Yet it's over $500, whereby you could be costing yourself tens and tens, if not hundreds of thousands of dollars in, implications if your legal, stuff isn't checked and
Well, of course.
I's dotted and T's crossed and that sort of stuff. Mate, we touched on it there briefly, but the principles of property is finance. I think you mentioned it in your opening statement.
Well, in increasing your creating financial abundance, that's the key. I mean, as I said, unless you want to have a bed in every single house you own,
Yeah.
God help you. But again, look, we respect that owning property and building portfolios is for creating financial abundance for yourself and your family. Yeah.
So you've done your strategic plan, your clients have accumulated in accordance with the plan that you guys have developed over the time of their portfolio. What happens then? What's the exit strategy? Do you sort of advise selling? Do you advise holding, living off the rent? Or is it varying depending on the person's circumstance?
Yeah, spot on. Everyone's different.
Yeah,
and
okay.
again, it depends on what stage of their life they're at.
Mm.
The key to holding property is to create ongoing passive income.
Mm.
And I'll compare it to superannuation. Let's say you retire in 20 years and your superannuation sum's going to be $1 million. Okay, so when you retire, it's $1 million. Depending on what you do with it, if you decide to take it out, well, have a think about what the value of the dollar will be in 20 years' time relative to what it is today. Because I'll guarantee in 20 years it'll be worth about half based on inflation. But averaging out, it's about half. So that $1 million will give you the benefits in 20 years of about $500,000. So that's a lump sum. Whereas if I've got a portfolio of houses, let's say they're worth $1 million now. Let's say I've got 2 investment properties on top of my own worth $1 million. Are they going to be only worth $1 million in 20 years' time? Of course not.
Probably not. But even if they are, they're still better off than cash.
Well, I say that because what will also go up is rent. And that will go up relative to the value of the dollar at any given time within that 20-year period and beyond that 20-year period. So it's a completely different scenario when you look at, okay, well, a set amount of dollars, superannuation, set amount, great, as opposed to an asset that will not only continually increase in value based on the relative value of the dollar, but also the passive income will increase at the relative value of the dollar through the ages. Does that make sense?
Yeah.
Yep.
And so, from a property standpoint, are there any gems or is there any areas that are really exciting you at the moment? or states? Location.
Look, Southeast Queensland is your key. And I say that not because I live here and I'll put people into property all around the country and New Zealand.
All right, okay.
And we'll continue to do that. But if you look at your value for money relative to your stamp duties,
Yield.
relative to your supply, relative to the migration and the employment, long-term employment opportunities, it keeps leading to Southeast Queensland. And again, it's a different planet to
Townsville,
Wide Bay and North Queensland. That being said, that regional areas now are really outperforming cities because of the fact that people now realise, well, I don't have to be in the city, and then it comes down to, okay, well, what's going to suit me that will allow me to have a 4-bedroom home and the likes.
I saw something the other day from a research company whereby it had a survey of the people purchasing or looking at property, and they were not focused on where they lived, and they were happy to move to Mackay as an example and enjoy the barrier reef and the beaches and the weather and all that sort of stuff, and move there without the intent or without the job already in place, but knowing that they could find some sort of remote work when the time come for it. So people are confident in that decision now too, or that mindset's certainly changing, where people have been like, used to be able to, I want a job before I get there, I need to find something, go door knock, but people are like, well, I'll just do Zooms and work from home. That's certainly part of the mentality of people now. Yeah,
that's right. And it's, it's always been dreamed about, but frowned upon because it would never work. Yeah. Now, this COVID guff has forced everyone's hand as an employer, including, the governments. And it's working like a charm, more productivity, much more cost effective on top of that. And, from all reports so far, greater employee satisfaction, which means greater retention.
Well, you've got all this technology and AI coming out where everyone's just tracked. Like, you can work from the office or home. I can still track the productivity of your job. How many calls have you made? How many emails you've sent? Who you've responded to? Yeah. You can see all that now live. So it's like, if you're sitting in the office, we need to add on an extra 100 square metres to the office and spend 200 grand buying it, or we can just filter some of the staff 2 days a week each. Yeah. Come into the office. That's and right. Everyone's still being tracked. So that it's not like you can get away with not performing, because it's all just being tracked anyway, with the likes of technology being pushed as well. So all these other companies, like Zoom, just went up, skyrocketed. Through meeting people. Damn it. But it's like, that's just one of them, of the tools of people communicating face to face without sitting down having a coffee. Like, I was getting when the property finished construction, I was speaking to someone that, I guess, a lawyer that specialises in getting the estates done for, like, my will. And he was just saying that he's basically doing an extra 2 appointments a day because of just people are even more efficient in the Zoom meetings. They have everything there. They're comfortable at home. The meeting's booked. He doesn't spend all the time travelling there, and it's just actually overall been better for his business. Yeah, that's right. It's less hassle and greater convenience for clients. Yeah. Without the intrusion of being in their home or them having to come into your office. And that also goes to employees, because, let's say the average half-hour transit to work, the average half-hour transit from work, which kills people because they just hate it. They've got an extra hour for their day, every other person. And now they can do appointments on Zoom, so they're not travelling. So immediate productivity, greater sense of freedom and independence. So as I said, it's really tracking into that search action for property and places to live. Mate, we've got to start to wrap it up, but what would be your single, if you have one, biggest tip for people at the moment there who may have property looking to buy? Is there anything, I suppose, a final to leave it with people watching? The biggest tip? So many, or a bit of advice to navigate COVID? Just do it for a start. And listen to this. If you listen to this podcast, well, take on board what you need to from here, because first home buyers and even people that have owned their own homes beforehand, most people, and respectfully, don't have the information at hand strategically to know how to do this the right way, because it's just like me going into a dental surgery and saying, hey, you know what, I know how to do your job as well as you. Yeah, step aside. Right. I read something online, watch the video, I'm all good. Bingo. People can't expect and put pressure on themselves to do it perfectly by themselves. Find someone, as I said, why I'm doing this is to help inform people, just like you guys are, about, look, guys, do it right, because the horror stories detract from what we do. Yeah. And the horror stories come from people that have just gone willy-nilly without themselves saying, hey, I bought my own home, how hard can it be? I'll go find a tenant because there's a million of them. It doesn't work that way, It's really understanding that, hey, you think about what it is you're aiming to achieve, think about what your budgets are, your time frames are, and then, take a bit of advice from other people about, how do I do this the best way possible, instead of just making the mistakes and saying, property investment's just a farce, it doesn't work, and it killed me. Unfortunately, more people do that
then come to people like me and get the real advice on how to do this the best way possible.
Nearly every time you ever hear a horror story, you actually ask them or break it down if it was them or one of their friends or someone at the barbecue. You actually sit down and work it out. You're like,
that's right.
You can work it out within seconds. You're like, so that's what went wrong? And they're like, yeah, that's what. I'm like, so that doesn't mean property investing's bad. You just made a really bad decision and on the wrong for a different outcome. You didn't know what that, you didn't get advice. You didn't get advice. You're just going to buy that, not knowing the outcome. So you can work it out very quickly. Most of the time it could have been an easy fix. It was just one little thing that you just got wrong, and now they've just branded buying investment property or buying a property is bad for them.
Yeah,
and it's just like I bought a property and it went really bad for me on the first one, but I had no education. I just wanted to do something different from my parents to own something, but I didn't know what I was doing. But I didn't let that deter me saying this was bad. I just knew that I'm going to trial and error to actually learn. As a young 18-year-old back then, I should have sought advice as well, but I had, just family at the time. I was 18 years old. Like, well, I don't even know who to see. What do you look up? Now it's a lot more prominent now with businesses around and professionals like yourself. But back then I was like, I'm just going to have to learn a good lesson in life and cost me a bit of money and then I'll make a lot more later. But
that's the price of the apprenticeship.
Yeah, that's right.
I was on $4 an hour.
Darren, how do people get in contact with you, mate, and your organisation?
Go to PIA Team, so piateam.com.au. That'll bring you to our website. It's got a lot of information there. I've got a half a dozen really useful short video tutorials to access. Certainly feel free to contact me directly on at info@piateam.com.au, as in team, team.com.au. PIA Team, that is, and as I said, feel free to shoot me an email, and I'm happy to discuss where you are and what it is you're aiming to achieve, and see if we can improve the outcome.
Awesome, mate. Thank you so much, everyone listening and watching. Darren Fisher, Property Investment Advisory. Please go ahead, like, share to this to anyone who may be interested. Darren, thank you so much for coming in. Really appreciate it.
Thanks, buddy.
See you guys. Bye.